Welcome to Avyukt Learning. So today we are going to continue our chapter 1. We are going to cover the last three topics of our lecture in chapter 1. So let's have a quick recap of what we read till now. So the first is meaning of accounting. Accounting is a systematic process of identifying, measuring, recording, classifying, summarizing, interpreting, and communicating financial information. Then we read about attributes of accounting, and then after that, we saw that accounting is both art as well as science, and the reason behind giving the conclusions. And also we cover the topic branches of accounting. So there are three branches. One is financial accounting, the next one is cost accounting, and the third one is management accounting. And then we saw what is meant by bookkeeping. Bookkeeping is a part of accounting. So it is the process of recording the transactions and events in the books of accounts. So it involves identifying, measuring, recording, and classifying the transactions and events. So this is what bookkeeping involves. And then we read about the difference between bookkeeping and accounting. And then we just classified them in six bases. And then we read the meaning of accountancy. So accountancy is a systematic knowledge, whereas accounting is the action or process. So accountancy carries the rules and principles. Accountancy contains the rules and principles, whereas accounting is a process carried based on accountancy. And the next topic is objective of accounting. So totally we have six objectives. The first one is record of financial transactions and events. The second is to determine the profit or loss of the organization. The third objective is to know the financial position of the organization. And fourth one is assisting the management with the financial information. The management can take a good decision regarding budgeting, forecasting the sale prices, forecasting their marketing performances in near future. So this is the fourth point. And the fifth is communicating accounting information to users. So, and then the last is to protect the business assets. So these are the six objectives of accounting. Next is advantages of accounting. So totally we have six advantages. So the first one is financial information about business. So accounting gives the financial information, that is profit earned or loss incurred, and also it gives information about the financial position of the organization. The second one is assistance to management in making business plans. Third is to make it facilitates comparative studies, like the current year's financial statements can be compared with the previous year's financial statements, and we can find out the deviations. And then the fourth one is it facilitates the settlement of tax liabilities. And fifth one is it facilitates loan. The banks and financial institutions will check our growth potential in financial statements, and they will decide whether to give loan to the company or not. So this is the fifth advantage. Sixth one is it acts as uh, it acts as an evidence in court of law. So these are six advantages of accounting. And the next is limitations of accounting. Accounting is not fully exact because many transactions are accounted based on the estimation, not actual. So accounting is not fully exact. So one of the best example is providing depreciation on the basis of estimated useful life of an asset. So this is one of the uh, example. The second limitation is accounting does not indicate the realizable value. Here, realizable value means, as I said, if we sell the asset in the market, what amount we can recover, that is realizable value. So it does not indicate any realizable value of asset in the financial statements. And then the third is accounting ignores qualitative aspect. The fourth one is accounting ignores the price level changes. That is, financial statements are prepared at historical cost. And the last one is accounting may lead to window dressing. Window dressing means manipulation. Accounts can be manipulated to show that the company is in a better position than what it actually it is. So these are five limitations or disadvantages of accounting. The next topic was accounting information. So accounting begins with identification, and at last we will prepare the financial statements. And in that process, each and every step generates some accounting information. With the help of with help of that information only, we will proceed to the next step. So after generating all the information, what we will do, we will communicate those information to the users of financial statements. So we could generate three types of accounting information. So the first one is information relating to profit or surplus. Second one is information relating to financial position, and third is information about cash flow. So in our previous lecture, I have told the thin line of difference between or surplus, profit and surplus. So I have said in the previous lectures. Uh, so this profit is for, we can derive our profit by preparing income statement, and our surplus, we can find out surplus or deficit from income and expenditure account. So we have profit organization. In profit organization, we will prepare trading account. Trading account gives gross profit or gross loss of the firm, and we will prepare profit and loss account, from which we can identify the net profit or net loss of the company. That is for profit organization. Not for profit organization. Not for profit organization means their main objective is not to earn profit but to contribute something for the welfare of society. For example, charitable activities, sports association, self-help organization, all these are not for profit organization. So what they will prepare is they will prepare income and expenditure account, and from that we can find the surplus. That is, if income is excess than expenditure, then it is surplus. Deficit means if expenditure is over excess over income, then it is deficit. So remember this. And then we read about information relating to financial position. So from the balance sheet we can find the financial position of the company. So balance sheet is also known as position statement. And the difference between profit making organization, the difference between asset and the liability is known as capital. In non-profit organization, the difference between asset and liabilities is termed as capital fund. So I said you in the previous lecture itself, the terms used in profit making organization and non-profit organization will differ. So the terms relating to non-profit organization we will read separately in a chapter called not-for-profit organization. And the third is information about cash flow. So cash flow, for to know this, we will prepare cash flow statement. So there we will record all the inflow and outflow of cash during a specific period. So this helps us to make decisions like payment of liabilities, expansion of business. All these plans we can make based on availability of cash. So I hope everything is clear till this one. So we will start with uses of accounting information. So this is one of the important topics of this chapter. So uses of accounting information may be categorized into two. One is internal users and external users. So we have users of accounting information is branched into two. One is internal users of accounting information. The second category is external users of accounting information. Internal users means within the organization, who are the people who wants to know the accounting information. So internal users of accounting information, totally we have three members. The first one is owner, second one is management, and the third is employees and workers. So owners. Uh, so to start a business, second. So guys, to start a business, uh, we need to have some, we need to invest some money in business, right? So what owner will do is, owner owner will invest some money into the business, and this is known as capital. So for example, we have Mr. X. He starts his business using rupees 2 lakhs, then that 2 lakhs is known as capital. Or let me give you one more example. Mr. X is there and he starts business with cash rupees 2 lakhs and computer. Of course, we need a computer nowadays to do business. Computer worth 60,000. Then his total capital amount will be 2,60,000. So now the company or the business should repay that amount to owner. So mainly owner is very much interested to know whether the company earns profit or not. So how company will repay its capital amount to owner is by giving more and more returns. Owners contribute capital in the business and thus are exposed to maximum risk. So whether the company goes well or not, the main benefited person will be the owners only, because they are they are exposed to maximum risk. They only carry more risk. So owners contribute capital in the business and thus are exposed to maximum risk. Naturally, they are interested in knowing profit earned or loss incurred by the business besides the safety of their capital. Even though if suppose the company incurs loss, but still the company can repay the capital amount, that is this 2,60,000 to the owner. That is not the problem. But still the owner will be interested to know whether the company earned profit or incurred loss. Next is management. The management makes extensive use of financial information to arrive at informed decisions such as determination of selling price, investments into new projects, cost control, etc. So selling price. So usually management will decide what amount the product should be sold at. So that for that we need to have a financial information, and then to make new investments into new project. If suppose the company wants to introduce a new product line, then also the company need to review the accounting information once, then only it can decide. And the third is cost control and many other things. Cost control is in how much production cost should I reduce, so that is cost control. So this is regarding management. And the third is employees and workers. Employees and workers are entitled to bonus at the year end, which is linked to the profit earned by an enterprise. Therefore, the employees and workers are interested in financial statements. Employees and workers used to get bonus every year. If the company performs well in a particular year, then employees and workers will get a good amount of bonus. So they are naturally they are keen to know the profit earned by an enterprise. So here, for example, there is something called as manager's commission, which is based on profit earned by the company. So every year, not every year, mostly what companies will do, they will give something called as manager's commission. For example, they will say that out of the net profit, I will give you 10% as manager's commission. So naturally, the managers will be very much interested to know the profit earned by the company. So that is one of the example for this point. I hope everything is clear till this. So the next one is external users of accounting. External users of accounting, totally we have five external users. The first one is banks and institutions. I guess I have explained this in our previous lectures itself. I guess it may be it will be I guess it will be in lecture 1 or lecture 2. So, okay. First one, banks and financial institutions are essential part of any business as they provide loans to business. They watch the performance of the business to know whether they are making any progress as projected to ensure safety and recovery of loan advances. So banks and financial institutions, every company has one or more than one loan. So generally banks and financial institutions will grant loan to the company. So what they will do is they will read the financial statements and they will know whether the company is uh, growing potentially or not. If they are satisfied with that, they will grant loan to the company or else they will not grant. If they're sometimes what will happen if the financial if the company is doing well, the bank themselves will go and offer the company a loan, that they will go and offer like you can take a loan if required from our bank with low percentage of interest. So they themselves will go and offer a loan to the company. So this is regarding banks and financial institutions. And the second one is investors and potential investors. Investment involves risk, and also the investors do not have direct control over the business affair. Therefore, they rely on the accounting information available to them and seek answers to questions like how safe is their investment, their earning capacity, etc. So, guys, investors and potential investors, we can call them as shareholders, preferential shareholders, or equity shareholders, debenture holders. They are investors. So, they preferential shareholders are not like those investors are not directly uh, connected with the business affairs. They cannot go and control the business operations daily. So what they will do is they will rely on financial information available to them, and they will see whether this company is doing well or not. If I invest my money in this company, will I get a very good return? Will I get the dividend amount correctly? If it is a debentures, will I get my interest at the right time? Will I get good amount of interest? Will my return be good? All these things they will come to know by just reading the financial statements. So mainly what they will see is their earning capacity uh, will be known from the financial statements. I hope the 2 points are clear. Now the third is creditors. Creditors are those parties who supplies goods or services on credit. Before granting credit, creditors satisfy themselves about the credit worthiness of the business. For example, if the company buys uh, if the company purchases some raw materials from a third person, for example we have ABC Co, and they purchase raw materials from Mr. K. So what K will do is K will supply goods now. He will supply goods now, but the payment will be on a later date. For example, today's first, today's first day of February. Mr. K tells, okay, you can give me payment for this particular supply on 15th of March. So the company, this period, this 1.5 month period is called as credit period. So this is known as credit. First we will give the goods, then we will make, then the payment will be done later on. That is credit period, and the person who gives that credit is known as creditor. This is like same thing, no? What we use in our day-to-day life, credit cards we use, no? That is, we will make payments using credit cards, and later on we will pay after the month end. We will pay them. We will pay the money to them along with some certain percentage of interest. So, how these creditors will grant credit? They will just see the financial statements, and they will know whether this person's credit worthiness is good or not. Credit worthiness means if whether he is paying his credit money on correct due date, or is he making any delay, or does he have any intention to to pay the amount if I give in credit. All these he will come to know by just evaluating the financial statement. So this is known as credit worthiness. Is he even credit worthiness means, is the company or organization deserves to get credit of goods, that is known as credit worthiness. So creditors will be interested in knowing the accounting information of that particular organization. And the third is government and its authority. Fourth is government and its authority. The government makes use of financial information to compile national income accounts and other information. Government levies various taxes like GST, income tax, etc. These government authorities assess correct tax dues after analysis of the financial statements. So, in economics, we will learn something called as national income. So, to calculate the national income of the company, to the government will uh, read the financial information of that particular organization, and government also levies GST and income tax, etc. So, what they will do is they will see the financial information, and for example, the income tax authorities will see the financial information and they will find out the net profit of the current year, and they will just make a cross verification that whether the company's actual payment to income tax and whether the figures shown in financial statements matches or not. They will make a calculation and they will just match it, whether they paid the tax amount correctly or not. So that is government and its authorities way of using the accounting information. And the last is public. They want to see the business running since it makes substantial contribution to the economy in many ways. Example, employment of people. So as general, public means in general, we people used to see how the company is performing, just to know the employment, how they are employing people, how their products are. So for all these things, we will verify financial statements. It is in general. I hope I hope this topic is very much clear to you all. So this is regarding uses of accounting information. So guys, in the next lecture, we will be seeing the last two topics. The one is qualitative characteristics of accounting information, and the last is double entry system of accounting. So these are the two topics left in this chapter. So in the next class, in the next lecture, we will complete this chapter. I hope everything is clear. If you have any doubt, please post it in the comment section, and also subscribe the YouTube channel, like and share. Thank you so much.